Well, maybe the last 5, but the last year or two,
Or the last 5?
I think I got out a little bit too late. So, if I had to do it again, I wouldn't have left Pimco, but in leaving Pimco, I would have gone straight to the golf course. I think I tried to prove too much, and I did it in a vehicle in the unconstrained fund that was a little bit offbeat from total return investing. So I'd certainly want to take that back.
Blackjack, you hit on 16.
Depends on what you're hitting into.
Okay, fair enough. But you know, everyone sort of was knocking you about the German Bund trade as well. By the way, after 40 years of building up $2 trillion in assets, people want to kill you over the trade. But I think the trade would make money now, right?
Yeah, it has. I mean, I lost money as the spread between Bunds, the 10-year, and U.S. Treasury's 10-year widened. It's now narrowed by a good 30 or 40 basis points. So if I was still around, I'd be making money, and they'd be singing my
People say, okay, why are you
praises.
talking to Bill Gross? He's retired. First off, you have a lot of money. You're still active. And what I think is cool is that you've, I don't want to say you're a stock guy, but now that you are unconstrained truly, it's your money. You can do with it what you want. You're buying individual equities like Annaly Mortgage.
Yes. I still have some Treasury futures. I don't have the Treasury Bund trade, which I had. But yeah, Annaly is a mortgage REIT. It's 5 or 6 times levered, and it depends upon the 2 to 10-year yield spread, so to speak. The spread is flat
Well, it was
and
inverted.
tremendously.
I'm sure it
was almost inverted, and that doesn't do well for not only for the Annalys of the world, but for the banks of the world. Now it's back out to 15, 17, 18 basis points, and perhaps moving higher as the Fed initiates QE in another form.
Don't call it QE. They told us.
I know.
Is it QE?
In another form, in a baby QE, because they're buying bills as opposed to 5s and 10s, and when they buy bills, theoretically that should widen the yield curve a little bit and provide some margin for banks and for mortgage REITs and the like that depend on that. You know, Brian, the capitalism itself depends on carry, and that's why yield curve flattening is so dangerous, because no one is willing to take risk by extending maturity and extending duration in order to capture yield. There's no yield to capture. And when you take that out into stocks and into real estate and so on, it's simply a reflection of capitalism at risk with a flat yield curve, because no one wants to take.
Everybody hated when the Fed initiated QE, just they didn't want the Fed in the market. But if they held their nose and bought equities, they did well. Is that part of your thesis with Annaly? Do you like a lot of other mortgage REITs as well? And will this baby QE push up all stocks?
Well, no. Baby QE won't push up all stocks. It'll help to salvage a day or two of repo madness in which interest rates can and did go to near double digits. So it won't salvage that. But I'm in there for the yield. The yield is 12%. There are other mortgage REITs that are similar. I like high dividend paying stocks.
Such as?
Such as Invesco, which is a investment management company. It trades at a 6 PE. It has a 7.5% yield, and yes, the active management business is under attack and has been for a number of years. But Invesco has a lot of closed-end funds in which the fee is fixed permanently. And so I like it from that standpoint, and I like it from the standpoint of the cheapness and the dividend and those types of things.
And are you one of these guys that's been buying into this utility rally? Because utilities have been just absolutely on fire. I don't want to say out of control, because it makes it sound like there's a judgment there, but 22, 24 times earnings?
I think it's a little hot. Not now. I sold the last of my Dominion Energy about a week ago.
Oh, you sold out of Dominion?
Yes, but it had a great run. It was cheap and undervalued because of electricity lines crossing the Appalachians and regulations and so on, but that's behind them for the most part. I think PPL, which is half UK and half US at the moment, it's a good.
Hold on. Can you hear that? Here comes Ben Bernanke with the helicopter of money. I think which is dropping down. So what's the last most fun investment that you've made then?
Well, there have been two arbitrage situations in the healthcare business. Allergan, which manufactures lenses and so on, is being bought by a health company called AbbVie. And there's still a good 7 or 8% in terms of a margin close-up if and when they close the merger 3 or 4 months from now. So I like that, and it's moving fast, and I'm making some good money in Allergan.
And I remember a few years ago, Allergan, I like that. I remember a few years ago you had a similar trade on LinkedIn with Microsoft, which went out very well. Not bad for a bond guy. Macroeconomy, U.S. recession the next 12 months?
No, but getting down there. I mean, we're down to 1.5% in my view. And the thing is, Brian, that fiscal stimulus that we've had with the $1 trillion deficit and the tax cuts and so on, to my way of thinking, they're basically played out. And you need another trillion, not just the same trillion, but another trillion to do the same type of magic. And so, that...
Will we do the trillion?
Oh, not in the next year and a half. Not with the Democratic Congress. Depends on who's going to be elected. If Warren gets in, for instance, yeah, we'll do another trillion for sure. But for the next year and a half, we just got to sit and watch and wait. And so the fiscal stimulus, which most of the world needs. Germany needs it, but they're so tight and they're so stingy that they can't spend money on their economy. They can only lower interest rates. And so my point is that the interest rate play is basically gone for most of the world because $17 trillion worth of bonds are in negative yielding. What lies ahead and what should lie ahead is fiscal stimulation, and that doesn't speak to good
running out of time.
Things about fiscal deficits.
Very quick. Do we get another rate cut in October?
We do.
Do we need it?
We do.
If Trump gets impeached, do you think that bond yields go below 1% as everybody flocks to bond? How does that impact the market generally? I know it's a big if, but if.
It hasn't so far. I think it should. And what would it do? It would slow the economy even more and might produce lower treasury yields, but not 1.5% or 1%.
Do you think Trump will be reelected?
I don't. I hope not.
Bill Gross, great discussion.
Thank you.
I don't think we've talked stocks in a long time. It's great to. Okay, I'm going to ask you this, because I said I wouldn't get too political. You said if Warren, who do you think, if Trump doesn't win, is it Warren?
I think she will be the candidate. Yes.
You think so?
I do.
And that we'd get another trillion maybe in stimulus.
I think Biden is too old and old-fashioned, and Bernie Sanders is too old and old-fashioned. I think Warren is the face of the future for the Democratic Party, like it or not.
And she has a very good chance of becoming president.
I think so, based upon what's happening now. Yeah.
And maybe we get that trillion and more stimulus or
I think for
fiscal
sure,
stimulus.
for better or worse. And some would say inflation ahead, and perhaps that's true. But remember, the Fed's been trying to get to 2% inflation for 10 years now, and it hasn't really made much
Maybe
progress.
Another trillion will do it. Listen, Bill, don't be a stranger. Anytime you need us to house sit, it's not exactly a mine, Kelly, but I'm happy to be here anyway. Don't be a stranger.